स्टार्ट करना हो तो बता दीजिएगा ही। हाँ जी।
Recording in progress.
हाँ जी। Very good morning, friends. So first of all, welcome you all to the ICAI Board of Studies LVC classes. Today we are starting with the financial reporting classes for CA Final. And let me first, I think, tell you that these classes are going to be complete detailed lectures. So these are not any kind of revision lectures. They don't presume that you've got any kind of base on the subject. We're going to start from the very scratch, and every topic is going to be dealt in detail in these classes. We will be, of course, doing a couple of questions also in the class. We'll cover the concepts, and we will also be doing a couple of illustrations from the study material as well as from the past examination questions, a few questions from the revisionary test papers, mock test papers, depending upon the intensity of the particular standard. I know most of you might be giving your attempt in the coming attempt, or maybe you've got your attempt later. But before we start, I would just also like to tell you that once you are going to do this subject, since financial reporting is a new subject, you're going to study the Indian accounting standards for the first time, and you're going to see that there is a lot of transition change as compared to the accounting standards, what you have done at the intermediate stage. Well, I think first, let me just also introduce myself. I am Kapileshwar Bhalla. I'm a chartered accountant by profession, and I would be starting today with you the concept of introduction to IndAS. So today is, of course, not going to be a very technical lecture, but of course, you'll get a lot of information which will help you in terms of understanding the subject further. So what I'm going to do today, I'm just going to give you a little history. I'm going to do a little storytelling today. And through the storytelling, you'll not only come to know what is the history of the accounting in India, but also where do we stand today and what are we going to see in the coming future times as well. So I would say this is one of the very interesting papers of the final. Of course, every paper at the CA final level is indeed interesting. It not only gives you a lot of knowledge as well, but of course, a very practical oriented knowledge. And my advice would be that when you're studying this subject, especially financial reporting, do have a little practical aspect in terms of things. Because now in the examination, the pattern is that you get certain MCQs as well. So in order to understand, in order to, do those MCQs, you need to get some conceptual understanding of the subject as well. Don't get into that rote learning that you just remember a concept. That's not going to be good, not only from the examination point of view, but also once you become a qualified chartered accountant. So I think on that, let's begin the journey. And we are now going to get exposed to, as I said, the chapter number 1 of the study material, which is called Introduction to Indian Accounting Standard. So as I said, I'm going to do a little storytelling today, but every portion of the story which you're going to hear today is somewhere or other connected to this chapter, and it's going to give you a sequential inflow in terms of what happened in India, why these Indian accounting standards came to India, what exactly is the difference between these standards which you studied in the intermediate level and what you're going to study at the CA final level. So before we come to the introduction part, I would just like to take you to some very basic inputs to begin with. We all know that when a company does accounting, it is preparing things in a particular sequence. So I would say when a company does accounting, it prepares a journal, and then it prepares a ledger, and then it is followed by a trial balance. And this trial balance becomes the base in terms of making what we call financial statements. This is, I guess, something everybody is absolutely aware of. When you studied in school as well as in college, we all understood this, that accounting is supposed to be done in a sequential manner. World over, companies would make a journal, ledger, trial balance, and followed by a financial statements. But I would like to draw your attention on one particular aspect, and that is when you're looking in terms of journal, ledger, as well as a trial balance, and if you're looking in terms of financial statements, there is something which I would like to highlight at this stage. The journal, ledger, as well as a trial balance is something which I would technically call them as internal documents. I would say that these are internal documents of the company. So when you say that these are internal documents of the company, what do I mean by internal documents? These are internal documents because they cannot be accessed by a public at large. No, unless, I would be a regulator, unless I would be an auditor of the company. So these are not records which are public in nature. Not everybody can access these records. Of course, you can, but we'll not get into that technical detail. But when you look at the financial statements of the company, I would say these are supposed to be external documents. Now, you would have easily understood when I said that these are external documents, which means anybody in the public at large can access them. You want to look at the financial statements of any listed company, just go to the website. Or at the max, just Google it, and you're going to get the financial statements of the company. So these are basically, you can say, public records, or you can say external documents, which anybody can access. Even if I'm not a shareholder of the company, I can still access the financial statements of the company. So undoubtedly, that brings us to a very important question, that if these are supposed to be external documents, I'm sure there are certain formats which every company is supposed to follow. There would be certain guidance to fill these formats. Please mind the words carefully. I'm choosing my words very carefully so to get the complete chain of thought. So as I said, if these are external documents, then I would say there are two important aspects which are coming to my mind. There will be certain formats which will be given so that every company makes a financial statements in accordance with those particular formats. And not only the formats, but even the guidance which is required in order to fill these formats, in order to prepare these financial statements, is something which consistently every company should apply. So I think coming to those two pertinent questions, I would say when we're looking at the financial statements, the two things are that as far as the formats are concerned, these formats are given in Companies Act. It is given in what you call Schedule 3, which you're very aware, because even at the intermediate stage, you studied the financial statements, which was covered in terms of Division 1. I'll come to that segregation. But these formats are given in Schedule 3 to the Companies Act. We'll talk a little more in terms of Schedule 3 in the coming lecture as well, though I'll give you some insights today because our basic objective today is the standards. So when it comes to the formats in terms of financial statements, these formats are given in Schedule 3 to the Companies Act 2013. And if you ask me that what is the guidance which is required in order to prepare these financial statements, I would say the financial statements are prepared on the basis of the guidance which is given by the Institute of Chartered Accountants of India, what you call accounting standards in intermediate, and we've got another accounting standards that is called IndAS. In journal, I would say the guidance is in the form of GAAPs. That's what you call Generally Accepted Accounting Principle. So the two things which comes to the mind is that when a company is making its financial statements, the first agenda is the formats of the financial statements, which is given in Schedule 3 to the Companies Act. And the guidance is in the form of gaps, and these gaps, I would say, as I already said, is given by the Institute of Chartered Accountants, and this is in the form of what we call accounting standards. As of now, let's call them as accounting standards. So when you're studying these Indian accounting standards, what is something which need to be very clear is that this is the guidance, this is the gaps which will help you in order to understand how the financial statements are prepared by a company. Okay. So I guess now we have got two agendas of discussion. One is the formats, which is going to be the agenda in the next session, because we're going to go very systematic. First, we're going to understand that what is this guidance, and then next we're going to understand the formats, which is going to be a part of a discussion in the next two sessions. In the next two sessions, we'll be typically doing IndAS 1, that's called presentation of financial statements. I know you would be saying, sir, we don't know what is IndAS. Why are you telling us the number and the name of the standard? No worry, you'll get very simply exposed to it. But let me tell you, in these initial three classes, a lot of grounding work is going to be done. So we're going to do a lot of grounding work for you, understanding what exactly is the Indian accounting standards, and also trying to understand the Schedule 3, that is the formats which is given for financial statements. I think that's pretty simple and straight. I don't think so there would be any questions coming in, but of course I can see there is the chat which is going on, and okay, I think so far you got just good morning messages. And I think a lot of wonderful people are there with me. If you get any questions in between, any concerns, please put that on the chat box. I will definitely entertain your questions as well. Don't let your questions await too much. If I feel it's a very right kind of a question at the right time, I'll certainly answer that as well. Okay, so I think let's begin the journey. Having understood that there is a format and there is a guidance, let's speak on the agenda number one. Let's slightly speak on the formats. Though I said we're going to talk in terms of the formats, not today. We're going to talk in terms of the formats in the next session. Now, but just to give you a very basic feel that when you're looking at formats, I'm just going to tell you that when you look at Schedule 3, when you look at the Schedule 3 as of today, I'm very choosy at times in terms of my words. I just said, if you look at the Schedule 3 as of today, because maybe if you're going to speak to me in another couple of months, maybe 6 months, I might change my statement and I might say that as of now, there are 4 or maybe 5 formats. Now, why I'm saying that, you will see very shortly. So as of now, if you look at the Schedule 3 to the Companies Act, the Schedule 3 to the Companies Act is divided in terms of 3 divisions. One is called Division 1, the other one is called a Division 2, and of course, the third one is called Division 3. So when you look at the formats of the financial statements, we have got a total of 3 different formats under the Companies Act Schedule 3. So we've got a Division 1, we've got a Division 2, and we've got a Division 3. Now, what you studied at the intermediate level was Division 1. Now, as of now, I'm going to make some statements. You might say, what is this statement implied? Don't get worried. As we progress further, you'll get the clarity. But let me just make a quick statements at this stage. When you look at the Division 1, these formats are followed by, I would say, companies or entities which follow the accounting standards issued by Institute of Chartered Accountants of India. So companies which follow the Division 1 is supposed to follow the guidance, which is the accounting standards, which you've already covered at the intermediate level. So this is what you covered at the inter level, where you looked at how the financial statements is prepared on the basis of those 29 accounting standards issued. Of course, in CA final, the focus is not going to be on Division 1. The focus is going to be on Division 2. And Division 2 is supposed to be followed by companies which are following what we call the Indian accounting standards. In short, we call them as IndAS. In short, we call them as IndAS. And this is what you're going to study at the CA final level. Now, a couple of questions would be coming to your mind. So what is the difference in terms of Division 1 and 2? Well, I would say there is a lot of difference in terms of Division 1 and 2, but there's nothing to scare. When you're going to look at the Indian accounting standard, trust me, you will fall in love with these standards. Terms and conditions apply. So if you're going to carefully study these standards, trust me, you're going to fall in love in the subject financial reporting, because these standards are based on the international accounting, and the way they've been created and we're implementing them in India is absolutely beautiful. Now, if you look at the Division 3 as well, the Division 3 is supposed to be also applicable, but this is applicable to what we call NBFCs. This is also applicable to NBFCs which are following the Indian accounting standards. So let me now make it clear that Indian accounting standards are supposed to be followed by NBFCs, and I would say other than NBFCs. Now, which companies follow Division 2? That we will decide. Division 1, that we will decide. So don't get worried on that. But when it comes to IndAS, I would say NBFCs will be applying Division 3 because they've got certain specialized kind of, you can say, assets in the balance sheet. So the format is slightly different when it comes to non-banking financial companies. They follow Division 3. But of course, the guidance is IndAS, and even for Division 2, the guidance is IndAS. You're not required to do the formats as far as NBFC is concerned at the CA final level. Your main concentration, of course, is going to be understanding the preparation of financial statements under Division 2. So I just wanted to give you a very brief, what is this Schedule 3 Division 2? How does it look like? Of course, we'll see more things in the next class, but let me just add something more. So let me just add something more in terms of Division 1 and 2. And I guess if you're wondering that are these notes going to be shared to us, of course, you'll get the access to the notes as well through the ICAI portal. So that means through the LMS. So no worries, once you're logged in, you're going to get these notes as well. So all this, what I'm writing, is going to be shared. But nevertheless, that doesn't mean that you don't write anything at this stage. Do keep writing. Your involvement in terms of writing, understanding is going to give you a lot of focus as well. Okay, a little more inputs which I want to mention at this stage, typically in terms of Division 1 as well as Division 2 and 3. Slightly more inputs at this stage in terms of the Schedule 3. So in terms of the Schedule 3, as we said, we've got Division 1 and we said we've got Division 2. Let's not talk in terms of Division 3 because our focus is Division 2. So let me also now give you what is the list of, or I would say, what are the components of financial statements under Division 1 and what are the components of financial statements in Division 2? Because many a times we do falter and we say, oh, what is financial statements comprising of? What are the components of financial statements? So right now I'm going to give you some terms. A few components will be absolutely new to you. So don't get worried on the terminology. As I said, you'll get connected with more informations coming in the next sessions as well. Now, if you look at the Division 1 and somebody were to tell me that, can you give me what is the list of complete set of financial statements? So let me give you what is the complete set of financial statements which is there in Division 1. I guess Division 1 is something which you're all aware of. You've done at the intermediate stage and you will easily tell me that Division 1 is supposed to be comprising, I would say, number one, what you commonly call a balance sheet. what we commonly call a balance sheet, that is one. Then you make what we call an income statement, or you can say a profit and loss account, or you call it as an income statement or a profit and loss account, as you commonly say. Then the third one is what we call a cash flow statement. The third component is what we call a cash flow statement. And the fourth component is what we call notes to accounts. The fourth component is notes to accounts. So in division one, when you studied at the intermediate level, at that particular stage, you learned that there are four components of financial statement: a balance sheet, a statement of P&L, or you call it as an income statement, a cash flow, as well as you can say notes to accounts. Now, at this stage, let me also remind you, Schedule 3 gives you the formats in terms of the balance sheet and the income statement only. Schedule 3 gives you the formats only for a balance sheet and for an income statement. The format of the cash flow statement is not in Schedule 3. This guidance is what you study in Accounting Standard 3. So it is the Accounting Standard 3 which gives you the inputs as far as the preparation of the cash flow statement is concerned. Notes to accounts is nothing but explanations of certain elements in the financial statements. So of course, they don't have any kind of formats. Now, coming back to the position, as far as division 2 is concerned, now if you ask me that what is included in the financial statements, now hear me carefully. Now hear me carefully. You are going to get some new additional components attached to the financial statements. Like for example, we are going to make a balance sheet, and the balance sheet is going to be accompanied by a document which is called SOKI. Don't get worried on the term as of now. Don't get scared on the term as of now. What is the SOKI? What is this format? You're going to learn it in the coming sessions. But you just need to remember that there is another document which is called statement, of changes, which is called statement of changes in other equity. So for you, as of now, it is just a terminology. So don't get scared on the term. But you should know that a balance sheet is accompanied by a document which is called SOKI. The full form of the word SOKI is Statement of Changes in Other Equity, as the word is Statement of Changes in Other Equity. So what is the SOKI? How does it look like? Don't get disturbed at this stage. We're going to see that later. So that's a later agenda. Right now, the objective is to put some components at the back of your mind. Similarly, the second document, of course, remains the income statement. So it remains an income statement, but let me tell you something very interesting again at this stage. Unlike the income statement which we prepare in terms of division 1, unlike the income statement which you prepare in terms of division 1, this income statement is comprising of profit and loss and something which is called OCI. Now you will say, sir, you're scaring me in the very first class itself. I am getting a feeling of something really new. Yes, there is something new which you're going to study, but trust me, we are going to learn in a very systematic, logical manner. So don't get apprehensive that what is this OCI or what is this SOKI. You're going to get exposed to that very slowly and steadily in the coming 2 sessions as well. So let me also put down the full form of the word OCI. So this is what we can say is called other. It is called other comprehensive income. It is called other comprehensive income. That's what we call OCI. So which means if somebody were to ask you that what has been added in terms of financial statements in division 2, you would immediately shoot out 2 things to them. You would say that there is an accompanying document along with a balance sheet, which is called SOKI. And there is another component added to the income statement, which is called OCI. No worries whether you can explain them at this stage, what is SOKI and what is OCI, because you'll get the answers by the next session. So this is a new document attached with a balance sheet. This is additional, and we've got something in addition in the income statement that's called OCI. And of course, the third component remains the same. We prepare a cash flow statement, which was prepared earlier in Division 1 as well. And we're going to make a cash flow statement as well. And of course, just to again remind you that in terms of Schedule 3, it gives you a formats only in terms of the balance sheet and the income statement. The Schedule 3 does not give you any kind of formats as far as a cash flow statement is concerned. Here again, the guidance in terms of cash flow statement is provided by IndAS 7. Just like there is Accounting Standard 3, there is a standard which is called IndAS 7 that tells you the guidance in terms of how a cash flow statement is prepared. You're going to see that in IndAS 7, the cash flow statement, but more or less, I would say if you look at the Accounting Standard 3 and the IndAS 7, more or less, the guidance is quite similar. I know another question which is coming to your mind is, so is my intermediate knowledge going to help me in terms of understanding these Indian accounting standards? Yes, largely. But you're going to learn a lot of new aspects as well, which you would be learning for the first time. But your knowledge at the intermediate level is especially going to be a grounding work in terms of understanding things. And of course, last but not the least, you've got notes to accounts as well. Okay, that's wonderful indeed. I've also got generally, you can say a good or a bad habit, but I also do one thing, as we keep making a progress, I just like to keep consolidating things as well. Though I think today, since it's not going to be very technical, I think you may not feel the need of doing a consolidations in between. But as we go to some complicated topics, you'll definitely feel a need in terms of consolidating things as well. So let's take a little recap and then start with the introduction back to you. So let's, I think, take a quick recap of the concepts with you. I have not given you much so far. I've just given you some very basic understanding of the subject, so that you also understand what you're going to study in CA Final in financial reporting. So basically what you're going to learn in CA Final, to put it short at this stage, you will learn the art of, you can say, preparing the financial statements under Division 2 to the Companies Act. And for this, you will also be understanding the guidance, the gaps, which is the Indian accounting standard. So every time throughout the lectures, you will be learning the Indian accounting standards. And of course, you will keep getting connected to the formats, the financial statements as well. So by the end, not by the end, I would say, but somewhere almost in between, you will get a complete flavor in terms of how financial statements are prepared under Indian accounting standard. So let's take a look quickly on this. I started my discussion today and I emphasized that when a company does an accounting, we all know that there is a sequence to accounting. And my focus is on the financial statements, which is supposed to be an external document. So when you say that it is an external document, it is open to the public at large. Anybody can access the financial statements of the company. So it is very important, since these are public records, there will be formats consistent for all. There will be guidance consistent for all. So what should come to the mind is that when you're looking at the formats given by the Companies Act, MCA, Ministry of Corporate Affairs, and that's called Schedule 3. And the guidance, which is called GAPS, is given by ICAI, Institute of Chartered Accountants of India, which gives you the accounting standards or the Indian accounting standards. That's one thing which I put in your mind. Then I said, let's talk a little on the formats, though our objective of discussing formats would be in the next session with you when we discuss IndAS 1. So in this particular case, I said the Schedule 3 is divided in 3 divisions as of now. The division 1 is for entities which follow accounting standards you did in intermediate. The division 2 and 3 is for companies which follow the Indian accounting standards. Division 3 is for NBFCs, non-banking financial corporation companies, and division 2 you can say other than NBFC. Considering the nature of the business, the MCA decided to give a different formats for NBFC and a different formats for other than NBFC. But as far as the guidance is concerned, it's a common guidance, that is IndAS. And then I just gave you a list of the complete set of financial statements comprising of, in terms of division 1, a balance sheet, an income statement, a cash flow, and notes to accounts. Schedule 3 only gives you the formats in terms of balance sheet and the income statement. Schedule 3, division 2 is got same components but something extra. Balance sheet accompanies SOKI, statement of changes in other equity. And income statement has got another component which is called OCI, that's called other comprehensive income. That's it. Simple and straight. Let me see any questions coming so far, then we could entertain. Okay, I think some people are saying my class is not yet started. Please check this, I guess, because we got a lot of people attached on the Zoom, I guess. Okay, so I think let's now begin the journey. This is done. So far, so good. So let's take it further. I guess we'll also do something, people who are there, I think, can definitely give me reactions. So don't open your unmute yourself. But if you've understood the journey so far, a one thumbs up on your hand gives us a go ahead to go further as well. So can we get some reactions on that? Okay, I think I got a question from Sharon. Is IndAS same as accounting standard 3? Almost same. Almost same. I would not say it is 100% the same, but yes, largely accounting standard 3 in the IndAS 7 is largely the same. Okay, that's wonderful indeed. Okay, so now let's take it further. I am now going to start with a journey of some story with you. Now it's story time. For a little while, we've taken you almost like half an hour or so in terms of giving you some base. Now it's storytelling time, and I'm going to carry on my story at least for another 1 hour or so. And in the story, you're going to learn a lot of things, certain things which are relevant from the examination point of view, certain things which will just connect the story. But of course, this is all based on chapter 1. Why I'm creating this story is that as you go through the story, you will automatically get the flow or the sequence of events as well. So I'm going to make a time scale and start my story. So I'm going to give you some important years, and I'm going to give you some inputs as far as these years are concerned. So this story, started in the year, I would say 1973. Oh my God. You would say, sir, you're going to cover a story of 50 years to us, and that's in a span of 1 hour or so? Yes. We're just going to cover a story and tell you what happened in the accounting world so that you get a connect in terms of Indian accounting standards and various other things. So 1973, then I would say the next event is 1977. Then the next event is supposed to be 99. There was nothing special which happened in 99, but I'll just let you know that 99 I've intentionally put on the scale because I became a chartered accountant in 99. So this is nothing in terms of the storyline. I'm just intentionally inserting that 99 in between. Okay, then let's come to 2001. Then we come to 2006, then we come to 2007, then we come to 2008. There are certain important events which happened in the events. Then there is 2010, and then it is 2016, then it is 2017, then it is 2018, and I guess we can make it as 2024 and onwards. So this is the important sequence of dates which we're going to use in our storyline. So once you hear the story, everything will become conceptually clear as well. So I put some important ears in front of you. So we're going to begin a journey. So please hear me very carefully. Relax on your seats, tie your seatbelts, and we're going to start a storytelling where you're going to pick up a lot of things. Okay. So what happened in 1973, before I give you a background, I am just going to add something to you. I'm just going to add something further to you. So do you understand the events? If you look at gaps, there is generally accepted accounting principle. Every country has its own gap. Mind the words. Every country has its own gap. But if you would ask me, which is the most popular gaps in the world? I'm saying if somebody would ask me, which is the most popular gaps in the world, I would say there are basically two important gaps in the world. I would say one of them is called US gaps. And I think as the name is suggestive, it is applicable in USA. And if you ask me in terms of another important gap, I would say it is IFRS. That's called International Financial Reporting Standards. So one is US gap. I said every country has its own gap. But if you ask me that what are the two major gaps in the entire world, I would say one is US gaps and the other one is called IFRS. That's called International Financial Reporting Standards. What is this IFRS and all? We'll be talking very shortly on this matter. Now, as we said, in terms of US GAAP, this is typically applicable in USA. And if you look at IFRS, it is typically applicable in United Kingdom, UK. Now, it's important also to tell you that these gaps are created by certain accounting bodies. Like, for example, if you look at the accounting standards, the body which creates these accounting standards, is ASB, Accounting Standard Board, which is a part of the ICAI, which creates these standards is called FASB. It is called Financial Accounting Standard Board. It is called Financial Accounting Standard Board. So we call it as FASB. I'm just giving you so that we understand the larger picture very clear. So there is a particular, you can say, board, accounting body, which creates the US gaps, and that is called FASB, Financial Accounting Standard Board. And in terms of IFRS, the body which creates these guidance is called IASB. That's called International Accounting Standard Board. That is called International Accounting Standard Board. So these are the two, I would say, most important, you can say, accounting bodies all across the world, which is creating the gaps. USA creates what is called US gaps. And IFRS is created by IASB, that is International Accounting Standard Board. Now, one thing is very important to tell you that if you look at the US GAAP, these are supposed to be largely, I said these are supposed to be largely rule-based standards. I did not say that they are completely rule-based standards, but they're largely rule-based standard. Now you would say, what do you mean by a rule-based standard? We'll see that. And if you look at the IFRS, they are largely, you can say, principle-based standard. So they are largely what we can say is a principle-based standard. So the next question what comes to the mind is, what is the difference between a rule-based and a principle-based standard? I think let's make your life very simple before we go further. Let me take a very simple example to illustrate the concept of what is a difference between a rule and a principle. Let's take a very simple example. In India, for example, we know in Delhi, because I'm from Delhi, so I'm going to take an example from Delhi. So in Delhi, we know that the driving speed is 50. When I'm driving within the city, the driving speed is 50. I'm not talking of the speed on the highway. So the driving speed is supposed to be 50 on, within the city. Now, let's say if the driving speed is 50 and I'm driving, let's say at 45. Do you think the police is going to challan me? No. Let's say I'm driving, let's say around 51 or maybe 52. Is the chances that, anybody is going to stop me? Perhaps no. And even if the police is aware that he's driving at 51 or 52, the chances are that he may say it's okay because it's not much of a variation. So what is the policeman actually doing? Is he applying his judgment in terms of taking a decision whether you are driving, at a wrong speed or not? Yes. When the speed limit is 50 and you're driving at, let's say, 48, or you're driving, let's say, at 51, 52, he applies his judgment, and based on that, he decides whether you should be challaned or not. Similarly, when you look at IFRS, which is a principle-based standard, in this particular case, the standards would require a professional, a chartered accountant to make a judgment. You will see that IFRS is going to give you a certain guidance, and you will have to use your professional judgment in terms of taking a call how the accounting treatment is done. Now, this would scare you. So you would say, what do we follow in India? Let me tell you in advance that in India, we follow the UK accounting. And we follow accounting which is principle-based, which is supposed to be judgment-based. But that doesn't mean that in the examination, the examiner is going to judge your judgment. Because judgment at times can be very subjective, and they may not like to judge you on judgmental levels because everybody has got different wavelengths to take a judgment. But having said that, the standard requires a professional to take a judgment on situation. Continuing with the same example, let's say I am driving in US and the speed limit, let's say, is 90. I'm sure the speed limit's a little higher. So let's say I'm driving in US and the speed limit is 90. You drive at 85, challan. You drive at 92, there will be a challan because 90 means 90. So rule means that you cannot deviate from what is given to you. So you can say the US gaps are quite rule-based standards. I'm not saying that there is no scope for judgment. I'm not saying that they do not contain any principle-based judgment, but if you look at US gaps, they are largely rule-based standards. So they leave a little lesser scope in terms of applying judgments. But IFRS is largely a principle-based standard, which means the moment it is a principle-based standard, it would mean that there is going to be a lot of judgment which will be required. And I just wanted to give you that as far as India is concerned, we follow the guidance which is given by UK. We follow the guidance which is given by UK. So this is a little background in terms of things before I start my storyline. So I hope you got the picture that every country has its own gap. But then if you look at the two major gaps in the world, one is US gaps, which is made by FASB, and one is IFRS, which is made by IASB. And the standards differ in terms of rule and principle-based guidance. India follows the guidance in terms of UK. Let's come back. So in 1973, let's come back to my storyline. In 1973, you can say the International Accounting Standard Board was established. In 1973, the International Accounting Standard Board was established in UK, and they were creating a guidance originally in the form of IAS. It's not Indian Administrative Service. It's International Accounting Standards. Sir, hold on. So just 2 minutes back, you said that IASB creates IFRS, and suddenly you are now telling me that it is creating IAS. You said IFRS is the document created by IASB, and suddenly you said that they were creating International Accounting Standard. So what is this IAS and IFRS? No worry, we'll give you that connect, but let me tell you at this stage, In 1973, they were originally creating a guidance which was called International Accounting Standards. Why today it is called IFRS, we will see as the storyline moves. But just remember, originally in 73, when IASB was established, it was creating a guidance which is called International Accounting Standards. Okay, next, moving forward, in 1977, Accounting Standard Board was established in India. So this was established in UK and this was established in India, Accounting Standard Board, and they were creating a guidance which is called Accounting Standards, which you studied in intermediate. So they were creating a guidance in terms of the financial statements preparation that is called Accounting Standard. Let me also tell you that Accounting Standard Board is a member body. We are a member of the International Accounting Standard Board. So the Accounting Standard Board is also a member of the IASB. That's why our accounting in India follows the UK accounting. As I said, today you're going to get a lot of knowledge as well. It's important to get that basic understanding as well. Then you're able to appreciate the subject on a larger level. So today the idea is to give you some general knowledge as well related to both examinations and a practical aspect as well. Therefore, I'm giving you the journey. But trust me, in the entire process, we are covering chapter number 1 as well. So don't think I'm just, taking your time away. I am covering the chapter indirectly as well through the storyline. Okay. So the Accounting Standard Board became a member of the International Accounting Standard Board. So our guidance of accounting standards was taken from the International Accounting Standards as well. So that was how things started off. Then I think I've already given you that what happened in the year 99, there was nothing happened in terms of 99. I just added this flavor because I became a chartered accountant in the year 99. So in the entire storyline, you can also just remember that, I became a chartered accountant in the year 99, but it's nothing a historical event. It's a historical event for me, but it's nothing any historical in the event of accounting fraternity. Okay. Now, I became a CA in 99, and I would now like to tell you something very interesting at this stage. You'll envy me for this. You'll literally envy me for this. You've all done your intermediate and you've studied around 29 standards. Of course, a few standards are not there. So almost there are around 27 standards, but I'll take it as 29 in number. Imagine how many standards I studied to become a chartered accountant in 99. I had at my time a total of 15 accounting standards. I had a total of 15 accounting standards which I studied to become a chartered accountant. And of course, people who are supposed to be seniors to me would have done even lesser standards. And I hear that some people became chartered accountants almost long time back when there were hardly any accounting standards as well. So I had just 15 accounting standards, but the things were getting complicated, transactions were getting complicated, and a guidance was required to the industry to deal with those complex accounting issues. And trust me, what happened over a period of just a couple of years, almost by 2001, the number of standards jumped from almost 15. And I think if I, rightly remember, there were almost, you can say around, almost around 21. They became 21. 5, 6 standards, massively came at that time. So we had almost 4 or 5 standards which were seen almost in a period of 2 years. Imagine the existence of 77 to 99, 22 years of existence, we had 15 standards. And suddenly there were so many complicated transactions happening. The industry needed a guidance, and the number of accounting standards was increasing massively at this stage. It was increasing massively at this stage. So what was becoming difficult is that every entity, if you tell every entity, boss, you are required to make your financial statements and you need to follow all the accounting standards issued by the ICAI, I think it's going to be, a little difficult for smaller company. If you look at, companies or entities, I would say, which are called SME, small and medium entities, it's very difficult to tell them that you also apply all the guidance which is available to make financial statements. Because many of them may be very small kind of entities, and I think the public interest in those entities may not be there. So in 2001, the Institute of Chartered Accountants decided that we're going to give some relaxations. We're going to give some exemptions, not from the accounting treatment, but from the point of view of, giving them exemptions from disclosures. They felt that it's going to be too overburdening for small and medium entities to tell them to apply all accounting standards in their financial statements. So they decided that, okay, we're going to give you some kind of exemptions and some kind of relaxations in terms of things. So at that time, the Institute of Chartered Accountants of India came up with the concept of what you already know, level 1, level 2, and level 3 enterprises. Okay, Ayush sir, I won't mind even if you take the time away if the class is this much interesting and practical. Thank you, Ayush. You made my day for that. Thank you very much indeed. So the Institute of Chartered Accountants of India came out with a concept of level 1, level 2, and level 3, where they decided to give certain exemptions and certain relaxations to SME. I'll not get into all that detail because all this detail you've already studied at the intermediate level. You've already done that at the intermediate level where you've seen that which entities are called as level 1, which are called level 2. So that's all related to intermediate. So I'm not getting into all those details at this stage. So everything was going smooth. So 2001, since the number of standards was on the rise, they wanted to give certain exemptions, but these exemption relaxations, again to emphasize, was only given in terms of disclosure. They never decided and they never gave any kind of exemptions or any kind of relaxations on accounting treatments. That is the focus point. They decided that we will give you some exemptions, we'll give you some relaxations only with reference to the disclosure requirements, not with reference to any accounting treatment. So everything was all good and everything continued. Suddenly, there was a little disruption in 2006. And I think due to this disruption, I need to come out of the storyline and tell you what was the disruption which happened in 2006. So I'm going out and I'm going to take you to the journey, what happened in 2006. So some pending questions also need to be answered. One of the pending questions is IASB was issuing International Accounting Standard. So why did you call it as IFRS? We'll answer that question also in this disruption itself. Now, what's this carefully? Here this carefully. What was the disruption in 2006? The major problems the companies were facing in 2006 was there was a lot of globalization. Now, when I say that there was a lot of globalization, many companies were establishing their operations worldwide. Many international companies worked well. A lot of globalization process started, though it started almost in the year 2000. But you can say that the momentum of that globalization was at its huge peak almost in 2000. Globalization happening. Now, but then that globalization was having its own consequences on accounting. I'll tell you how. Imagine there is a company A Limited, and it has established its operations in different countries across the globe. So there is a company which is A Limited, let's say it is incorporated, established in India, but it was carrying on its operations across the globe. So let's say it was having its operation in India, it was having its operation in London, it was having its operation in USA. So they were having their operations all across the globe. And this company, let's say, is a listed company as well. So in India, it is listed on Bombay Stock Exchange. In London, it is listed on London Stock Exchange. And in USA, it is listed on New York Stock Exchange. This company is a listed company, and since it is a listed company, it is listed on different stock exchange. Now, the main issue is that this company, which is listed on the Bombay Stock Exchange, is required to submit its financial statements based on what we call IGAP. It is called IGAP. And let me tell you at this stage, when we use the word accounting standards, we can commonly also call it as IGAP. Interchangeably, we use the word accounting standards as IGAP. IGAP means Indian GAAP, generally accepted accounting principle. So since it is listed on the Bombay Stock Exchange, it is required to make its financial statements, which is based on IGAP. It is listed on a London Stock Exchange. It is required to make its financial statements based on International Accounting Standards. I'm still using IAS. And it is also listed on the USA New York Stock Exchange. So it is required to make its financial statements based on US GAAPs. So as I said, every country has its own GAAP. I just said that earlier, that every country has its own GAAP. So in this particular case, the company was required to make different financial statements based on different GAAPs. And you know the biggest problem? The biggest problem in all these cases, is that there is a huge gap, the English word gap. There is a huge gap in terms of these GAAPs. There is a huge gap in terms of these GAAPs. If you look at the guidance which is given in international standards or given in US GAAPs, you already seen that US GAAPs are largely rule-based. International accounting standard is largely supposed to be, you can say, principle-based. And our accounting standards, of course, was again based on the UK standards. So companies were facing a lot of trouble. You're planning you're spreading your wings all across the globe, and you're overburdened in terms of making financial statements on different GAAPs. As many stock exchanges you're listed, you're required to make different financial statements on different stock exchanges. Imagine the time, imagine the effort, imagine the cost involved in terms of things you are going to spend because of this. Not only a huge time, you're also going to spend a lot of efforts, and you're also at the same time going to spend a lot of cost as well. The time, efforts, and cost involved was getting extensive. So people were looking at some kind of a relief. World over, the companies were looking at some kind of relief. I can give you a simple example to understand this. You will notice the moment I've started the session, I am speaking only in English. I am not speaking in Hindi. Because majority of us all understand English. I know there would be students from our southern part of India as well who may not be very comfortable in terms of Hindi. So using a language which everybody can commonly understand. This very thought clicked to people. You were standard setters. They said that if there is a language which is commonly understood all across the globe, then even accounting is a language. If you ask me what is accounting, I would say it's a language the financial statements speak. The financial statements are made on the basis of a language, and that is called accounting. So even accounting is a language. So they thought that in this particular case, can we have some kind of a standards, some kind of standards which are called global standards. And these global standards are such that if you make your financial statements based on the global standards, it is accepted all across the globe. Let the National Stock Exchange or the Bombay Stock Exchange, or let's say the London or the New York Stock Exchange, will they easily accept those financial statements prepared on something called global standards? The only solution in terms of saving that time, efforts, and cost was that we needed something which is called global standards. So they decided that there was a need to create global standards in India and abroad. There is a need to create global standards, I would say, all across the globe. Somebody had to take that effort. Somebody had to decide that, okay, we are going to create some global standards, and these global standards are going to be accepted all across the globe. So, in the effort of creating these global standards, who came ahead? International Accounting Standard Board. IASB, which was already creating the international accounting standard, they said, we are going to create these global standards, and they decided that we will call these global standards as IFRS. That's what you call International Financial Reporting Standards. It is called International Financial Reporting Standards. You're about to get the connect in terms of IFRS and IAS as well. So they decided that these global standards is going to be nicknamed as IFRS, that is called International Financial Reporting Standards. Now, there was a little agenda. If you see and if you remember, you would remember that International Accounting Standard Board had already international accounting standards with them. They already had international accounting standard with them, and they said, we are going to create IFRS. We're going to create global standards. This is their existing standards, and this is what they wanted to create. So they said, let's do one thing. Let's consider International Accounting Standard as a part of the IFRS. So they said, we are going to consider our existing standards, which is IAS, as a part of IFRS. So when I say IFRS comprises of, I would say it comprises of International Accounting Standard as well as IFRS. So when I say the word IFRS, it automatically includes International Accounting Standard. Now, you would have got the answer that IASB is creating IFRS, and IFRS is a combo stage. If you look at the number of international accounting standards today, there are a total of 41 international accounting standards. We've got a total of 41 international accounting standard, but many of these standards do not exist. Out of 41 standards, I would say approximately only around 25 standards are there in existence. Why? Certain standards were deleted and IFRS was created, because they decided to, create these global standards. So what the International Accounting Standard Board does, they are slowly and steadily deleting these international standards, and they're creating new standards based on them. So today, effectively, there are around 25 standards which are there in this series. So in terms of IS 41, IS 1 to 41, there are effectively around 25 standards which are there. The number is 1 to 41, but many of these standards don't even exist. Like, for example, if you look at IS 3, 4, 5, 6, they don't even exist. The number, the name doesn't even exist. Yes, they were there once upon a time. So they started creating IFRS, and as of today, we've got 17 IFRS. Though there is IFRS 18 and IFRS 19, which has also been issued quite recently, and they're going to be applicable in 2027. So they've already released IFRS 18. To tell you, IFRS 18, once it becomes applicable in 27, IS1 will go. Today, what is called IS1, that will go, and there is going to be IFRS 18. So this will further go down. So that is the reason we say that IFRS is comprising of IAS and IFRS. So now you have got your answer that ISB originally started creating international accounting standard. But then they slowly said that we're going to move over to IFRS, and this IFRS is, if you call me effectively, there are around 16 standards because IFRS 4 has been withdrawn. So effectively there are 16. So more or less you can say there are around 40 odd standards which governs the guidance internationally. So this is the connect in terms of IFRS and IAS, that there are around 40 standards. But let me also give you some more insights. Let me give you some more insights as well. I hope you're catching all the new informations coming to you. The story is going in a systematic manner, but the idea is to keep giving you some inputs connected. What we are studying, Introduction to Indian Accounting Standard. Sir, where is that IndAS so far? You must be thinking, where is that IndAS so far? You soon going to see the connect in terms of IndAS and the IFRS as well. Now, IFRS was also comprising of another two documents as well. If you remember in the intermediate, studying the accounting standards, and you must have also heard about ASI, that's called Accounting Standard Interpretations, which are now a part of the accounting standard itself. So when you would have studied the accounting standards at the intermediate level, you would have seen that there are a lot of interpretations which were given by the institute, and those ASI now have become a part of the standard. Similarly, there is a lot of interpretations which are given to these standards. Some interpretations pertains to IFRS, and some interpretations pertains to International Accounting Standard, and those interpretations are called SIC. So the interpretations SIC relates to IS. This is called Standing Interpretation. This is called Standing Interpretations Committee. This is called Standing Interpretations Committee. So this was the old committee. This was the old committee which was giving the interpretations on the gray areas on the International Accounting Standard. So that committee was called SIC, Standing Interpretation Committee. And the new committee is called IFRIC. And this is called International Financial. It is called International Financial Reporting. International Financial Reporting Interpretations Committee. International Financial Reporting Interpreting Committee. So International Financial Reporting Interpretation, not interpreting, Interpretation Committee. So this is the full form of these committees as well, SIC as well as IFRIC. I remember long time back in 2008, when that trouble was coming, 2006, our discussion is pertaining to 2006. In 2008, I remember distinctly, in the examination, there was a question which came for, I think, around 4 marks, which said, write a short note on IFRS. And people thought, what is this IFRS? At that stage, people are thinking, what is IFRS? And they just wanted your understanding at that stage that IFRS is the global standards, which is comprising of these 4 documents, that is IFRS, IAS, SIC, and IFRIC. That is the background. So I hope you got the connect in terms of IFRS and the International Accounting Standard. So let me just, I think, quickly consolidate this before we go back to our story time. So I was explaining you the disruption which was happening in the year 2006 globally. All this disruption was happening at a global level in the year 2006. And due to this particular disruption, which was happening globally, there was a need, an emergence of global standards. Does this mean that with these global standards, a company will make its financial statements on global standards and it is accepted all across the globe? Not really. As of now, you can say yes, but yes, the intention was so, but the intention was so that you submit your financial statements on global standards and it is accepted all across the globe. But it can't happen exactly that way. But trust me, these global standards have narrowed down the gap between the standards. The global standard is actually narrowed down because countries are now applying indirectly IFRS. Countries are now indirectly applying IFRS. You would have guessed that even India is applying IFRS indirectly, and that's called Indian Accounting Standards. So with these global standards, many companies directly, indirectly applied in their countries. I said directly, indirectly applied these standards in their country, and India is one of them. And it's applicable almost around 180 countries across the globe. You heard me correct. There are almost 180 countries across the globe which are directly, indirectly applying these global standards. Now, what is direct, indirect? We'll see that later. Okay. So we've seen that these global standards the job was taken by IASB in terms of creating these global standards. And we've got IFRS comprising of IAS, IFRS, SIC, and IFRIC, 4 documents comprising the IFRS. Remember, this is going to be important for me as I take my journey forward, that there are 4 documents comprising the IFRS. Okay, let me just go back to my timeline. So here we were. So this is what was happening at a global level. So this was happening at a global level. Accounting was undergoing a massive change. The companies were feeling the need of global standards, and India could not have been left behind. Even India was having a lot of globalization, witnessing a lot of globalizations in a country at that stage, and India could not have been left behind. So, what was a very interesting event which happened in 2006? The Institute of Chartered Accountants of India decided that we will implement IFRS. We will implement IFRS in India, and this will be implemented on 1st April 2008 for certain major companies in India. So we decided in the year 2006. We decided in 2006 because of the global events happening, that countries were switching to global standards. Even India decided that we will also implement IFRS in 1st April 2008. Let's at least big companies, listed companies, which were called as public entities, where there was a public money, let them ask them to make their financial statements based on IFRS. Trust me, that was the first time I heard about IFRS in life. I will not hide anything from you, but this was almost in 2006 that I formally, understood that there is something called IFRS. Now let's change your mood slightly. I have been doing some lighter topics only, I think, but still, let's change your mood. So it reminds me, it takes me down to the memory lane, what happened in 2006. I always believe, and I believe it till date, that, threats can be good opportunities in life. Trust me. Threats at times can be good opportunities in life, because what people perceive as threats can be seen as opportunities by others. Our accounting is evolving in such a beautiful manner. You all know that there has also been coming in of what you call BRSR, that is called the Business Responsibility and Sustainability Reporting. Sustainability reporting is growing very big in India and internationally as well. You can see the concerned dimensions in the coming time. So in 2006, when I looked at that IFRS is coming to India, I was fascinated with the fact that this threat is going to get converted to opportunities, and it did. I thought, let's go and have a look at a book called IFRS. And I went to the bookshop. If many of you from Delhi, you would have also gone and seen some bookshops below the Institute of Chartered Accountants. If you've been to the place ITO, you must be aware that in ITO there are two bookshops. I think those two bookshops are still there. And I also went to those bookshops because all the books were quite available, private publications. I went to that bookshop and I said, "Sir, I want a book on IFRS." I was quite young at that time. I'm still young, don't judge me on that. Age is just a number. I told you 99, I qualified, but don't judge me on my age. So anyway, so I went to that bookshop and I said, "I want a book on IFRS." He looked at me with a very different kind of an eye. I could understand that later why he was looking at me like this. He said, "You need a book on IFRS?" I said, "Yes, I need a book on IFRS." He bought two books on IFRS, and trust me, I'm not exaggerating. The book was, this much, 2 volumes. This was the total size of the book at that time. I reminded myself that in 99, I studied almost 8 subjects and became a chartered accountant. And this one book on IFRS seems to me equal to 8 subjects in life. I asked him, "What is the price of the book?" And you can't imagine, when I heard the price, I was taken away. Can you make a wild guess? He said the books are worth 10,000 rupees because the books were international books. They were supposed to be imported from UK. And he said, "Sir, 10,000 is the price of the book. I'll give you a 20% discount." I said, "I'll give you at 8,000. I said, "Boss," internally in my mind, "you give me at 5,000, I can't afford them." You're talking about 8,000? 8,000 rupees for books on IFRS. I thought it's going to be a very difficult subject. If the books is costing 8,000 and the volume of the books is so huge indeed, it's going to be a big, big opportunity. But I thought the threats are more than the opportunities. Anyway, that was for a lighter moment. So anyway, the institute decided that they will implement IFRS on 1st April 2008. And then they also they constituted a study group at that time. And the study group was, constituted to look into that if IFRS is implemented in India, what kind of troubles, what kind of challenges are we going to face? So after this announcement in 2006, there was a study group which was constituted. And in this study group brought out a report. In 2007, the study group brought out a report, and in this report, they expressed the challenges which are applicable in terms of implementing IFRS in India so soon. So I will not get into the details of that report. You want to see it on academic knowledge. I think it's still there on the website if you can search ICAI.org. So the institute had some more considerations also. What were those considerations? We'll speak on, but they decided in 2007 that we have decided to defer the implementation of IFRS as of now. There were certain operational difficulties because we were looking at application of international standards for the first time in life. So there were a lot of operational difficulties as well. I was very happy. I thought, we're going to get some time to study those big books indeed. And it was decided that this deferment, they decided that we are going to make a deferment. We will defer these standards at least for a period of 2 years. So they decided that the implementation of IFRS is deferred at least for a period of 2 years. I thought it's a good time. I took some steps which I will not share publicly at this stage, but I took some steps, and my journey in terms of learning IFRS started in 2007. Today we're standing in 2024, years gap, and trust me, I'm still learning. The level of field in this is so interested that I'm still learning in terms of IFRS. So 2010 was decided tentatively as a date when IFRS will get implemented at the regulatory authorities and at the institute level. So let's, I think, talk of that. Let's talk of what was boiling down in 2000 in terms of 2008 and 10. So we are back on 2008, 2010. So let me now give you a little insight on that as well. I hope, the time passes by. Did you realize that almost 1 hour of my storytelling is done, but my story has got some more facets coming in? Okay, let's, I think, go further now. So I've come out of my storyline to give you a little more inputs what happened in 2008 and 2010 over a period of 2 years. Now, one of the major challenges which the Institute of Chartered Accountants and the regulatory authorities were facing, because now they decided that the implementation of IFRS, they decided that when we are going to do the implementation of IFRS in India, we've already said that we're going to defer it for a period of 2 years. The questions which came in front of them was that do we go in for what we call adoption? Or do we go in for what we call in 2010 that we will not implement IFRS in India, but we will converge to IFRS, and therefore our standards are also called converged to what we call today as Indian accounting standards. The other important question which was coming to the mind is that do we do away with the accounting standards we have? Or do we continue with the two set of standards in India? One is accounting standards and one is IndAS. So we also decided that along with this IndAS, we will also continue the accounting standards also. We will continue the accounting standard also. Let's implement the converged IFRS, that is Indian accounting standards, in a phased manner in India. Let's not apply this to all the companies in India. So we decided that we will have two gaps in India. We'll continue with the accounting standard for certain entity, and we will implement this Indian accounting standards for certain companies. Can you see the word? I said accounting standard to continue for certain entities. I'm using the word. And they decided that Indian accounting standards is going to be introduced for certain companies in a phased manner. So they decided that we will go in for a phased manner implementation. We will implement the Indian accounting standards. The implementation of the Indian accounting standards is going to take place in a phased manner in India. That's what they decided. But taking this decision was not enough in itself. Now, there were certain interesting challenges coming in. And I would like to tell you that when we decided to converge into the Indian accounting standards, what we technically call them as IndAS, the Indian word is put in a short form as Ind. So we decided that once we go to converge to IndAS, there were certain challenges. And I would now like to give you those challenges, which is important for you as you study these Indian standards. So let me now add on to the inputs, the challenges. So we're going to look at the challenges which we faced in terms of implementing these Indian accounting standards as well. Now, I'm going to give you two major challenges which we faced and how did we tackle them, because this will give you a conceptual understanding as you will read these IndAS in the coming sessions as well. Now, let's give you the challenges which came in. Challenge number one. The first challenge which came across was we've got IFRS and we decided to create Indian accounting standard. Now look at this. This is a very interesting challenge, and we very beautifully, manage this particular challenge. So we know on one hand we've got IFRS and we want to converge to Indian accounting standards. So just to remind you, if you remember, in IFRS we have got International Accounting Standard 1 to 41. You've got IFRS that is 1 to 17. You've got SIC and you've also got IFRIC. You've got SIC and you've also got IFRIC. So we've already said that there are a total of 4 documents which are there in terms of IFRS. It is IFRS, it is IAS, it is Interpretation, SIC, and IFRIC. Now see what we did, interestingly. So we decided that we're going to call this International Accounting Standard as IndAS. We're going to call this IFRS also as IndAS. But there was a little challenge, because if you say IS 1, IndAS 1, and then you say IFRS 1 is also IndAS 1, and that's going to be a problematic for us, because they've got IS 1, they've got IFRS 1, but we are planning to call both of them as IndAS. So we couldn't have said that, IS 1 is IndAS 1, IFRS 1 is IndAS 1. So we decided to keep the numbers same, and we decided to create the series 101 onwards. Now you would see, when you will study these standards, so don't get worried. When you see that it is a series which is running in 101 onwards, you know that you're studying IFRS. So when you're going to study, let's say, for example, IndAS 102, you will say, okay, IndAS 102 is IFRS 2. When you're going to say, I'm studying IndAS 2, you'll say, okay, I'm studying IS 2. So they change the series number. So this series was kept exactly the same, but this series was changed in terms of 101 to 117. That's the history, how the numbering of the standard was done. Because many people later say, so why do you have got IndAS 102? Why is the series running in a digit of 100? Because it was decided that we're going to call both of them as IndAS. And today what happens, the moment any IFRS is issued, we are also implementing those IFRS in the form of IndAS. Like, for example, IFRS 17 was recently issued, and we have also recently implemented IndAS 117 applicable from 1st April 24. Though there was a slight little gap, IFRS 17 became applicable internationally on 1st January 23, and IndAS 117 has become applicable for 1st April 24, but there were certain challenges, but more or less we are implementing them directly in a converged form. Next. This SIC and IFRIC, they were all inserted as appendix in the standard. They were all inserted as appendix in the standard. Now, if you look at any standard, if you look at the text of any standard, you will see in the text of every standard there is an appendix A, appendix B. So these appendix A and B are nothing but interpretations which are given in the appendix to the standard. So that is how we organize the Indian accounting standard. So we've got IFRS, that is IndAS. We've got IS, that is called IndAS. We've got IFRIC and SIC appendix to the Indian accounting standard. That was challenge number 1. Now let's come to the challenge number 2. And this was a very interesting challenge, which of course you need to know as you're going to study the standards further. The second challenge was, this is IFRS, and this is IndAS. Now, please hear this very carefully, because this is a crucial point which we need to understand. So this is IFRS and this is IndAS. So what we did in this particular case, now, as far as IFRS is concerned, there was one area where we said we do not agree. There was one area which we said we do not agree. IFRS said you need to account it like this. But in IndAS, we said, no, we do not agree the accounting prescribed in the IFRS. So this was called technically as a carve-out. This was called technically as a carve-out. So one of the areas where we had a disagreement with IFRS, IFRS was giving a certain accounting, but we said, no, we don't agree with this accounting. Under the Indian scenario, we do not agree. So when you go to study these IndAS as well, you will see certain areas which we're going to call as carve out. That means the areas where we did not agree with these standards. That's called carve out, disagreement. Then there were certain areas where you can say the IFRS was a bit silent, because those kind of accounting issues perhaps were not being faced internationally. So we did not have any kind of guidance in the IFRS on those issues because they were slightly silent on the agenda. So, but we decided that we will definitely give some inputs on those areas, and that was called carbon. So the areas where we had a disagreement was called a carve out, and the areas where the standard was silent, this was called carve in. So we introduced some inputs. And we said we would give guidance on certain areas which are silent in IFRS. So where we disagreed, carve out. And where we said, okay, let's give some more guidance, it was called carve in. And there was another interesting thing. Now see what this carefully. IFRS was giving two alternative treatments. Alternative one, alternative two. We said no, only alternative two will apply, or only alternative one would apply. So there were two alternatives given. There were two alternative treatments given, that you can do treatment one or you can do a treatment two. We restricted this to only one alternative. So we said in India, we will not allow both the alternatives. We will restrict the application of these only to one alternative. And that is called not resulting in a carve out. So this is what is called not resulting in a carve out. So this is called not resulting in carve out, because this is not an area of disagreement. It is like narrowing down the treatments available. So when it came to IFRS and IndAS, we got broadly three areas. The areas where we disagreed with IFRS, we created what we call a carve out. And there are not more than around, I would say, below 10. The total number of carve outs which are there where we had a disagreement with IFRS is almost below a number of 10. So I think around 8-9 major carve-outs are there where we had a disagreement with IFRS. Areas where the IFRS was silent, but we wanted to introduce some guidance, and that was called carve-in. And the areas where IFRS said you got two alternatives, but we said no, only one alternative will apply. We are not giving you two alternatives. And that was called not resulting in a carve-out. So these were the two challenges which we faced in terms of implementation of IFRS by putting the numbers and also by deciding the guidance. And that's how the Indian accounting standards came into account. So this was the background which was getting created at the background. So let me just come back on the time scale. This was the background which was happening in 2008. So when 2008, we first decided to implement IFRS, and then we said, no, we're not going to implement IFRS as of today. We decided we will go in for a convergence. And therefore, we can say that India decided to apply what is called converged IFRS, or what is called Indian accounting standards. Many countries in the world have implemented, if you remember, I said directly, indirectly IFRS. So if you ask me that what did India do, I would say they indirectly implemented IFRS. Because when you're looking in terms of the implementation, I said it's direct, indirect. I remember, if I'm not wrong, if my inputs goes correct, in Nepal, they've created a complete adoption of IFRS. So they have something which is called NFRS. That is called Nepal Financial Reporting Standards. So they decided to implement IFRS as it is. But India decided that according to the regulations, the legal framework of the country, we're not ready to implement it as it is, but we want to do it in a changed manner. So now you have got a little history in terms of what is this IndAS, how did this IndAS get implemented in India. Now comes the next phase of the story, that once we were ready in terms of implementation of the IFRS in India, Next came the input that how do we implement IndAS in India? And this implementation, as I said, started in a phase-by-phase manner. A portion of the story is still left, but the main storyline which I've given you, as I said, almost around 1 hour we are done. I'm sure now you would need a little break as well. I'm sure to relax your minds, though I think there was nothing heavy today, what we discussed, but that was just a background in terms of things. So now what we're going to do, we're going to give you a small little break before I will give you how the phased wise implementation happened in terms of Indian context. Let me in the meantime see if there is any questions coming in, or otherwise time to give you a break at this stage. Okay, so far so good. So I think let's give you a break, friends. So around 10 to 12 minutes, I should be back, just on a safe side. So 10 to 12 minutes, we'll be back. Please relax your minds, and we'll start back in 10, 12 minutes. Enjoy your break. Can we start, I guess? Right. So let's, I think, begin back. Hope you had a relaxation of your minds. So we were discussing a storyline where I had reached a point in 2010, and we decided that India decided to go in for a convergence of IFRS, and that was in the form of what we call the Indian accounting standards. And I exposed you the challenges which came in on implementation, the numbering, and the areas where we decided to get a carve in, a carve out, or something which is called not resulting in a carve out. Let's come back to our storyline. So we decided the implementation of IFRS in a phased manner. Instead of chartered accountants and the regulatory authorities decided that we will implement the IFRS converge IFRS in a phased manner. So the implementation in a phased manner started, you can say, from 2016 onwards. This was called a phase 1. We'll see a little more details on this. 2017 was called the phase 2. And 2018 is when the NBFCs, if you remember, Division 3 became implemented in terms of things. So the implementation of IndAS in India happened in a phased by phased manner. So we decided certain companies in 2016, April 16, certain companies in 2017, and the NBFCs in 2018. So we'll come to that 2024 onwards later. Now I'm going to take you to the study material as well. In order to understand that this is something which is also given in the study material. So I am now going to discuss a little in detail that what companies were covered under the phase manner, that is in phase 1 April 16 and in phase 2 April 17, because this is what you're supposed to know, because there are certain technical calculations also in terms of deciding whether a company falls in a phase 1 or phase 2. So there are a couple of illustrations also given the study material. So now we're going to come to the phased manner implementation. So this is what I've taken from the study material itself, chapter 1. And I guess let's, I think, begin the journey. And I'll give you some insights as we do. So I hope this is pretty much visible. I think so. Now, it says Ministry of Corporate Affairs notified what we call, I think, let me just underline this bit as well, the company's IndAS rules 2015. Now, let me just give you a little basic insight on this. For the implementation of the Indian accounting standards, there were rules established under the Companies Act. And these rules are what we call the Companies IndAS Rules 2015, which has been amended from time to time. The recent amendment has taken place just a couple of months back when IndAS 1117 has been introduced as well. So originally, the rules pertain to 2015, but they've been amended time to time. It says it had notified a total of 39 accounting IndAS at that time. So today, we have got, of course, a lot of IndAS. Okay, now let's come to the inputs in terms of the phased manner implementation. The phase 1 was supposed to be, you can say, for listed entity. The phase 1 was for listed entity. Now, this is something which you need to know. So let me just go clause by clause and tell you that phase 1 implementation was applicable to which companies. It says, as per the company's IndAS rules, the following companies were covered under the phase 1 for the accounting period, which is on or after 1st April 16, with the comparatives for the period ending 31st March 16. Now, let me explain something more, because this is what you need to know, though the time scale is also given in the study material. But let me just give you an exposure that once a company falls under a phase manner, what is it supposed to do? So let's have a look. Let me just take a time scale to illustrate the things to you. So let's say this is a time scale. And we're looking at companies which implemented IndAS in a phase 1. So let's consider this to be in two parts. This is, let's say, 1st April 16, and that is ending March 17. So this is starting 1st April 15, and this is ending 31st March 16, as good as 1st April 16. Now, watch this carefully. In a phased manner, the companies were told that when you're going to make your financial statements for the year 16-17, because when you say it is applicable 1st April 16 onwards, so we said that when you're going to make your financial statements for the year 16-17, you need to make them as per IndAS, that is Indian Accounting Standards. But every time a company presents its financial statements, it is also required to present a comparative financial statements for the previous year as well. But the companies in the previous year would have already made their financial statements as per accounting standards itself, because they decided to implement the IndAS on 1st April 16. So the financials for 16-17 undoubtedly is going to be made as per the IndAS. But the previous year, that is 15-16, was prepared as per accounting standard. So what the company is required to do, they are required to restate the financial statements and prepare them as per IndAS. So this is what we technically call restatement. This is like you restate the financial statements for the previous year. So if you technically ask me, the IndAS got implemented to these companies on 1st April 16, or I would say effectively on 1st April 15. Because you need to make the financial statements for the current year as per IndAS, and you need to give a comparatives for the previous year also as per IndAS. Though the financials were made as per AS, but they need to be restated in terms of IndAS. And not only that, but there is another interesting point to watch. On 1st April 15, the company is also required to make what is called an opening balance sheet. A company is also required to make what is technically called an opening balance sheet. So this date, not a complete set of financial statements will be prepared. Please mind the words. You're going to see this in IndAS 101 as well. But when a company implements IndAS for the first time in its life, it is required to make, you can say, a complete set of financial statements on March 17. It is required to make a complete set of financial statements on March 16. But it is required only to prepare a balance sheet on 1st April 15, not a complete set of financial. Now you would say, why do you need to make a balance sheet on 1st April 2015? Because that becomes indirectly a starting point in terms of implementation of IndAS. So any company, when it decides to go in for adoption of Indian accounting standards, so they would do the current year in terms of IndAS. They will restate the previous year in terms of IndAS, and the 1st April of the previous year, only a balance sheet is required, not a complete set of financials is required. And this opening balance sheet is technically also called a third balance sheet. So when you're going to see the IndAS later, you're going to see that they are also using the term called a third balance sheet. Why is it called a third balance sheet? Because you're making one balance sheet on March 17, you're making one balance sheet on March 16, and therefore this becomes a third balance sheet. So there will be two income statements. One is for 16-17 and one is for 15-16. No income statement required on 1st April 15. And this 1st April 15 also, let me tell you, is technically called, this is called the date of transition. This is called the date of transition. The date when there is a switch over from the IGAP, that is accounting standard, to the Indian accounting standard. So let me put it again. So we were looking at the phased manner implementation of IndAS. So the first phase started on 1st April 16. So companies would make their financial statements for 16-17 based on Indian accounting standard. But since you need to give a comparatives, the comparatives for the previous year, which were originally made as per accounting standard, needs to be restated as per the Indian accounting standard. And you're required to make only a balance sheet, not a complete set, on the 1st April of the previous year, that is 1st April 15, which is called the date of transition. That was one input. Let's come back. So we were talking in terms of this. Let's come back on this area. So it said that as per the company's IndAS rules, the following companies are covered under the phase 1, and that is on or after 1st April 16, with the comparatives for the period ending March 16. The comparatives for the year ending would mean we're looking at the financial statements for 15-16. And I've also said that you're also required a third balance sheet on 1st April 15 as well. Let's read further. It says companies whose equity or debt securities are listed or they are in the process of being listed on any stock exchange in India or outside India and having a net worth which is 500 crores or more. Let me explain this. In the first phased manner, we decided that all listed company, whether your debt security is listed, whether your equity security is listed, whether you're listed in India, whether you're listed outside India, and there is an and in between. So you need to focus that there is a plus another condition as well. The net worth of such companies is 500 crores or more. The question arises, what is a net worth? As of now, understand that net worth is something like a capital employed, but there was a complete definition that what is a net worth. We will see very soon that how this net worth is computed. How do you say that the companies will fall under the phased manner implementation? But remember one thing. The first parameter, the first companies which were covered is, it said companies which are listed or they are in the process of getting listed. Even my company is not listed today, but I have applied for listing. I am in the process of listing. I will be covered in a phased manner provided the net worth of my company is supposed to be 500 crores or more. So get this straight. So any company whose debt equity securities are either listed or they are potentially listed in the process of getting listed, and they're listed in India or outside India, and the other condition is the net worth is 500 crores or more. 500 crores inclusive or more. Next. It says companies other than those covered by clause A and having a net worth which is supposed to be 500 crores or more, even if the company is not listed, even if the company is not in the process of getting listed, but your net worth is supposed to be 500 crores or more, you're still covered under phase 1. So which means what? Listed companies with a net worth 500 crores or more, yes. Potential listed companies with a net worth 500 crores or more, yes. Unlisted companies with a net worth of 500 crores or more. So the basic agenda was, if your net worth is 500 crores or more, whether you're listed, whether you're in the process of listing or whether you're unlisted, you are supposed to apply the IndAS for the year 16-17 with the comparatives and the opening. Then it said the holding, the subsidiary, the joint venture or associate company, these are what we can call as related party. If the Indian accounting standard is applicable to you, it's also going to be applicable to your related party as well. So if it is applicable to me, it's applicable to my parent. It is applicable to my subsidiary. It is applicable to my JV, joint ventures and associate as well. I hope you have a little idea, of course, what is a subsidiary, JV and an associate company. So moral of the story, if you look at the phase 1, I would put it in a very condensed manner like this. If I were to put it, I'll document the notes also. If I were to put it in a phased manner, which companies got covered in a phased manner? I would say companies which are listed, which are in the process of listing, or they are unlisted, provided the net worth is 500 crores or more. So it's not all listed companies, mind you, it's not all listed companies covered in phase one. Listed, unlisted, potentially listed, if your net worth is 500 crores or more, and to their related party. Who is the related party? The subsidiary, the parent, the associate, and the JV. Now, what is net worth? We'll see that. What is net worth? We'll see that. Let's go further. This was the implementation in terms of phase one. And I think I've already given you that chart. I've already given you that chart in terms of the phase manner, but we just quickly make a run through on that. Okay, and Ayush, could you please show how to analyze how the third balance sheet looked like in actual financial statements of a company? Yes, you're going to see that once we come to the area in terms of IndAS 101. Right now, we're just going to concentrate on the phased implementation. Next class itself, you're going to have a look in terms of financial statements. So you can see out here that it was applicable for the year 16-17. So you need to make the financial statements for the year ending 16-17 and also the comparatives for 15-16. And as I said, you need to make an opening balance sheet on 1st April 15. So the companies which were covered under the phase one were required to make a complete set 16-17, a comparative set 15-16, and a third balance sheet on April 15. Now let's have a look on the phase two. The following companies are covered under phase two, which is for the period on or after 1st April 17, with the comparatives for the year. The comparatives for the year would mean it is for the year 16-17. Accounting standard 16-17, which we stated as this. Entities are listed in the second phase. So in the whosoever is left over. So can we say as in 500, they got covered in phase one, and listed companies with this stage, or if a company is basis, even if you're not Indian accounting standard, you got your commitment kardi, there is a voluntary went in for adoption of adopt the then also if it is voluntary. Let's make your life simple. So I am out here, and we say in terms of the net worth computation implementation. Yes. So we can say 1st April 16, phase 2, FCs are concerned. Would be coming to your mind that is IndAS applicable as of now? No. Originally, when this phase-wise implementation was introduced by the MCA, they decided that we're going to implement the Indian accounting standard to, implementation of the phased implementation. It was very clearly announced that even the Indian accounting standard would apply to the banking and the insurance sector. But due to certain operations applicable to the insurance company as well as to the banking sector. But hopefully we are looking forward that maybe from 1st April 25, but there's no official announcement, don't take it otherwise. There is no official announcement, but there are bright chances that maybe we could see the implementation of the Indian accounting standard from 1st April 25 to the banking sector and to the insurance sector. 1, 2, 3. Now, since the banking sector is again a very specialized kind of industry, the insurance is also very special for the insurance sector. As of today, the banking sector applies a different set of formats for financial statements as per the Banking Regulation Act, and the insurance sector follows the IDRA, the Insurance Regulation Development Authority Act rules. So therefore, they've got different banking sector and the insurance sector. Once they come under the purview, you could see a division 4 and 5. Maybe that's just a. So if somebody were to ask me that, can you please summarize the inputs in terms of the phased manner of implementation? If you're looking at the phased manner of implementation of the Indian accounting standard, I would say it started on 1st April 16. Which company? Let's put it in condensed. I would say if the company is listed, I would say if the company is in the process of listing, the company is in the process of listing, or I would say that even if the company is unlisted, But what is the main parameter is that they have a net worth. What is important is that they have a net worth which is supposed to be 500 crores or more. So what is important is that they've got a net worth which is 500 crores or more. And I guess I'm getting a question. So in how many classes FR will be finished? You will soon get a schedule on the site as well for that. But we're going to spend good time, don't worry on that, because these classes will be comprehensive and you're going to get almost a good level of number of classes and all. So if you're thinking that you'll have to study something on your own, no, every topic is going to be covered in a comprehensive manner with illustrations, concepts, and everything. Okay. So when you say that it is listed, it could be listed in India or it could be listed outside India. So that is one parameter. It is listed in India or it is listed outside India, and whether we are listing equity security or you're looking at a debt security. So we can say this is the implementation, listed, in the process of listing, and which are unlisted company, whether debt equity securities are listed, whether listed in India, outside India, provided the net worth is 500 crores and more. Plus, we said we will include the related parties as well. And when you say that you're going to include the related parties would be the parent company, the company which controls you, the subsidiary company, the joint venture, as well as the associate company. So this is, in a nutshell, we can say is the phase 1 implementation. Now let's have a look in terms of the phase 2. Now, in terms of phase 2, we can say all the remaining, whether it is listed company or whether it is supposed to be in the process of listing. So any company which is left over in the phase 1, all the remaining listed company, all the remaining companies which are in the process of getting listing. And we said unlisted company, which is got, you can say, a net worth, which we can say is supposed to be a net worth 250 crores or more, but less than, you can say 500 crores. So the limit was set for unlisted companies out here, that all the unlisted company which have got a net worth of 250 crores or more, but less than 500 crores. And of course, we also covered the related parties as well. So all the related parties of 1 and 2, they were also covered. And I think needless to mention out here as well, that when you're saying listing, this concept is equally applicable in India, outside India, debt, equity, whatever. So what is the status as of today, if you ask me? I would say, are all listed companies covered under IndAS irrespective of the net worth? I would say yes. Are all potential listed companies which are in the process of getting listed covered under IndAS irrespective of the net worth? I would say yes. But what about the unlisted companies? Unlisted companies only if they've got a net worth of 250 crores or more. So listed all, potential listed all, but unlisted only if the net worth is 250 crores or more. And I think let's also make a quick mention out here that as far as this is concerned, there was a voluntary adoption as well. They also allowed a voluntary adoption as well. Even if you're not falling under the phase manner, you're still free to implement this. So we can say the voluntary adoption would be that even if a company is not covered, even if the company is not covered by phase 1 or phase 2, even if the company is not covered by phase 1 and 2, it can still implement IndAS. It can still implement the Indian accounting standards. But the input is you cannot take a U-turn. So you can still implement IndAS, but you cannot but you cannot go back to, accounting standards. So once you apply the IndAS on a voluntary adoption basis, you cannot go back. Right, so I hope I'm very clear on the implementation on April 16 and April 17 as well, though we had to talk in terms of April 18, which is applicable to the NBFCs. Okay, I am also getting a question from Kishan, sir, at SME stock exchanges. No, there was a clarification which was given that if your company is listed on a small, medium exchanges, no, then IndAS doesn't become mandatory. So this is going to be, the big stock exchanges. Okay, another question comes from Ayush. Sir, if the parent company is applying a US GAAP as it is listed on the New York Stock Exchange, then also do we need to make financial statements in IndAS? If yes, we need to make two financials. There is a small illustration which I'm just about to do with you, which will give you the answer that if your parent company is, let's say, not in India and it is applicable to some other financials, some other gaps, like you said, US GAAP, is it required to make the Indian accounting standard? Let me tell you in advance, of course not. But your subsidiary company, if it is in India, it is going to get covered under IndAS if it falls in a phased manner. Then you'll have to convert the financial statements of the subsidiary in terms of US GAAPs to do the consolidation of the subsidiary in terms of the parent company. But we'll take a similar example very soon on this. Okay, so this was one inputs which I gave you. Phase 1 is done, phase 2 is done, and now I think before we go to NBFC, I think it's time to give you the inputs on the net worth, because there is a practical illustration which is given on the net worth calculation under the Companies Act itself, which tells you how do you decide the company is in the net worth. Though I think if you look at today, this calculation of net worth is going to be relevant only for those unlisted company, because every company which is listed automatically is got covered under the IndAS now. So this calculation effectively remains, you can say, for practical levels only for unlisted company when the net worth is supposed to be 250 crores or more. So let's have a look on the net worth. So it says for the purpose of determining the applicability of IndAS as per the roadmap, the net worth is being defined under Section 2, Clause 57 of the Companies Act. It says net worth means the aggregate value, the sum total of the paid up share capital and all the reserves created out of the profits and security premium account. The word is very clear, out of the profits created. It says out of the profits created. So reserves created out of profits. So if you've got something which is called a revaluation surplus, which arises due to considering your property, plant, equipment at a revaluation model, which you've seen, for example, accounting standard 10. So if a company would have used out of the profits, so the revaluation surplus will not be taken into account in the calculation of the net worth. And it says, of course, you'll take a security premium after reducing the aggregate value. It says accumulated losses, deferred expenditure, and miscellaneous expenditures not written off as per the audited balance sheet. The wording is very clear, as per the audited balance sheet, but does not include reserves created out of revaluations, write back of depreciations, and amalgamation. There could be something which as per AS 14, an amalgamation adjustment reserve. So it very clearly said that if there is any reserves out of the revaluation of the assets, revaluation surplus, or there is something which is called amalgamation adjustment reserve, which was created on account of accounting standard 14, that is not to be taken. We'll see a practical illustration as well. So basically, they said you're going to take the sum total of the paid up share capital plus the reserve and surplus, but those reserve and surplus will not include, for example, revaluation surplus, will not include amalgamation adjustments, but it will include a security premium, and you will reduce all kind of accumulated losses, any miscellaneous expenditures, any deferred revenue expenditures, etc. But all this calculation is going to be based on, it says, as per the audited balance sheet, which means you are going to consider the balance sheet on 31st March 14. Because if you're going to implement in a phase one, mind it, if you're going to implement in a phase one, 16, 17 IndAS, 15, 16 is IndAS. So you are going to look at a balance sheet which is audited effectively on March 14. So whatever is the position of the net worth on March 14, that would be taken in terms of phase one. And if you're looking in terms of phase two, then we'll look at March 15. Whatever is the net worth on March 15, that would be taken. I know there will be few more questions coming in. So could you please ask Zoom user to turn off the video so that your screen is visible in full? I have already put myself on a spotlight, so I don't think so there should be a problem, I guess, because I put my video on a spotlight. You can also put me on a spotlight, pin my video as you watch this, so that you know if there is any kind of disturbance, you'll only see my video, only no anybody else video will come. So please pin my video at your end as well. Okay, so let's go further. Now let's have a further look at an illustration as well. So before that, a small little clarification as well. So before that, let's look at a clarification. It says the net worth shall be calculated in accordance with the standalone financial statements on March 14 or the first audited financial statements for the accounting period which ends after that date. So generally, if you're looking at a phased implementation, phase one, you're going to look at the net worth on March 14. And if you're looking at a phase two, you're going to look at a balance sheet on March 15. And remember, you need to consider the net worth based on standalone, not on consolidated financial. If there is a company which is making group financial statements as per accounting standard 21, you're making a consolidated financial statements, we are not going to look at the group financial statements. We need to consider the standalone financial statements of the company and then decide a net worth. Okay, and then it says for companies which are not in existence on March 14 or an existing company failing under any threshold limits, the net worth shall be calculated on the basis of the first audited financial statements after that date, in respect of which it meets the limit. So in any case, if your company was not in existing, then you need to see whatever is the first audited financial statements of that company. Based on the first audited financial statements, you are going to take the net worth. So now let's have a look at the calculation, the application of the net worth. So I think we've seen very clearly that in terms of the net worth calculations, you need March 14 phase 1, you need March 15 phase 2, and then accordingly we decide the implementation. So let's look at now illustration number 1. It says following is the snapshot of audited balance sheet of a company on March 14. I'm intentionally circling certain important information in the question. This is the audited balance sheet on March 14, and the company's equity shares are listed on Bombay Stock Exchange since 2010. Remember, in terms of phase 1, the focus point. Now let me give you focus. Now, let me give you a simple focus in terms of this. If you're looking in terms of phase 1, the first question you need to put across: listed, potentially listed, or unlisted. So you need to see, is it listed? It works. It is in the process of listing, it works. It is supposed to be unlisted, it works. And the second focus point, what comes in? Net worth. The second focus point is net worth. You can't simply say that if it is supposed to be listed, let me bring it in phase one. As of today, of course, every listed company is covered. The net worth criteria is irrelevant, but we're looking at this question when the phase one was implemented. So you've got two focus points. Is it listed? Yes, it is listed. So the condition number one is met. Now you need to see the net worth, and this net worth should be 500 crores or more than 500 crores. Then I'm going to cover this in 1st April 16 manner. Let's read further. So the first condition is met. Now just net worth. So we look at the asset and the liability side of the balance sheet as per the roadmap, which phase company A falls into. Will your answer change if it is an unlisted company? So let's, I think, first calculate the net worth of this company and then see further. So in terms of the net worth, are you going to consider equity share capital? Yes. Are you going to consider security premium? Yes. Are you going to consider general reserve? Yes. Are you going to consider revaluation reserve? No. Are you going to consider a profit and loss account? Yes. Are you going to consider liabilities? No. And from this, is there any reduction required? We need to reduce the miscellaneous expenditure as well. So you will add up the sum total of the share capital, premium, and the general reserve, add up the profit and loss account, and from this, you're going to reduce the miscellaneous expenditure, and that's going to give you the net worth of the company. Okay, Ayush, so why 31st March 14 and not March 15 for phase one? Well, we said we need the audited balance sheet. So it might be a possibility generally that on 1st April 15, because when you implemented the standards on 1st April 16, your balance sheet on March 15 would not have been audited by then maybe. So that's the reason. If it is available, yes, but otherwise the audited balance sheet, which will practically be available to you for a 1st April 16 implementation, is going to be March 14. So if it is available, though difficult, then I'll take March 15 itself. But generally, practically March 14, right? Okay, so somebody has already given me the answer that the net worth in this particular case is coming to 505. This is coming to 505 crores, right? So you just add up all this and reduce 80. I hope you made a reduction of 80, correct? So this gives me a total of 505 crores. So if it is 505 crores, then it gets covered in the phase one. So this gets covered in the phase one itself. So let's see the other question as well. Will your answer change if the company A is an unlisted company? No. Because even if it is an unlisted company and the net worth is 500 crores or more, we still covered under phase one. So the answer would still remain the same. Great. So that was a good calculation. Let's, I think, have a quick look at the answer as well. So let me just take you out here. So we've already seen the calculations of the net worth with you, and we're just going to have a quick look out here. So we've already done the calculations, 505. So the company is a listed company and it does meet the net worth threshold. Hence, it will be covered under the phase one. So the IndAS will become applicable on or after 1st April 16. Even if it is an unlisted company, the net worth criteria is still met. So it will be covered under the phase one itself, and these standards would apply 1st April 16. So the focus points, I'll now make your life even more simpler. I'll make your life simple. I generally have a habit of, creating 3 steps in terms of understanding things. Though today is a very simple day, and I don't think so we need too much complications, but let's make your life simple. When you're looking at the applicability of the IndAS, I would say there are going to be 3 steps you're going to see, though the second and third is a bit connected. The first is you're going to look at, is it listed, is it potentially listed, or is it unlisted? If I say yes, I go to the step number 2. I will say, let me calculate the net worth is at 500 crores or more. And a connected step is you are going to see this on March 14. Because you need the net worth based on the audited financial statements. So you're going to pick up March 14 audited financials. Second and third is more linked. So when you're doing a particular question, get the focus clear. You are first looking at the nature. Is it listed? Is it potential listed? Is it unlisted? Then you're looking at the net worth. Is it 500 crores or more? And the net worth which you need for phase one is March 14, which is supposed to be the audited financial statements. Right? So far, so good. Okay, let's now go to the next one indeed, and let's have a look at illustration. What happens? We'll see that. Let's say in illustration one, the balance of profit and loss account is negative. When IndAS should be applicable to company A? Will your answer change if A is an unlisted company? If your profit and loss instead of positive becomes negative, and that also to the extent of 375 crores, undoubtedly the net worth will fall below 500 crores. Let's get the answer from your side. In this particular case, will the company be covered under phase one? Of course not. Will you be covered under phase two? You tell me. And if it is an unlisted company, will it get covered in phase two as well or not? Let's first calculate the revised net worth. Can you tell me what will be the revised net worth based on this illustration? If we say that the profit and loss is negative, that means we are taking this 75 as minus 375. So can you quickly give me what will be the net worth of this company? It comes to 55 crores. So the revised net worth is supposed to be 55 crores. Now the quick questions which goes to you. When IndAS will become applicable to A? Now, if company A is supposed to be a listed company, and he says, what happens if company A is an unlisted company? Well, if you look at a listed company, if it doesn't get covered in phase one, it certainly gets covered in a phase two, irrespective of the net worth. So this company, which has got 55 crores, will definitely get covered under the phase two because net worth criteria is not applicable for a phase two. Because when you're a listed company, 500 crores more, phase one, anything less than that, 0 to 500 crores is phase two. But if you're an unlisted company, do you still get covered under phase two? No. Because phase two is applicable to unlisted companies when the net worth is supposed to be 250 crores. So this company is not going to implement IndAS either in a phase one or in a phase two if it is unlisted in nature. Simple and straight. Great. So that was the illustration number 2. Now let's look at a few more questions with you. So let's have a look at the illustration 3 and let's have a look at the illustration 4. So once you get the concept, then you can practice questions as much. So let's now look at illustration 3 in the study mat. It says the net worth of company B, which is an unlisted company, is 600 crores on March 24. However, due to losses incurred in 14-15, the net worth became 400 crores on March 15, from when the company will apply IndAS. As I already told you, that once the IndAS becomes mandatory or you voluntarily adopt IndAS, there is no looking back, there is no U-turn which is allowed. So in this particular case, if you see, it is an unlisted company, and the net worth of that unlisted company is supposed to be more than 500 crores. That means it meets the threshold limit. So assuming that this is the net worth which is based on audited financial statements as well, so I would say the company would implement IndAS in phase 1 itself. Now, after the implementation, if the net worth goes down, you cannot take a U-turn after that. So whether it's a voluntary or whether it's a mandatory implementation of the IndAS, once you fall and apply IndAS, nothing works. So when it says that in the next year, 14-15, the net worth is below the threshold limit, would not make a difference. So let me just put the key inputs. So we can say if the net worth criteria is once met, then it shall be required to comply with IndAS irrespective of the fact that later the net worth falls below the specified criteria. So that becomes a clarification, but we've already seen that if you are implementing IndAS because of the threshold limits met, it gets met on March 14. What happens on a subsequent date cannot change the status. Okay, that was illustration number 3. Let's see further. It says illustration 4, the net worth of company C, an unlisted company, is 400 crores on March 2014. However, the net worth of the company is 600 crores on March 15. From when should the company apply IndAS in this particular case? So the input now is the reverse of what is given in illustration 3. In illustration 3, you got covered under the phase 1 and then the net worth went down. I don't care. But in illustration number 4, he's telling you that your net worth criteria was not met as an unlisted company, but your net worth went to March 15, which exceeded on that date. So would you be covered under a phase 1? No. Will you be covered under a phase 2? Yes. So this company will get covered under a phase 2 in this particular case. But this issue was addressed by the institute as well because of a lot of issues arising on the implementation of IndAS. The institute established through the Accounting Standard Board what is called ITFG, that was called IndAS Transition Facilitation Group. So you can see ITFG Bulletin 1. So when the companies were implementing IndAS in India, a lot of clarifications were required, and you can say one of the part of the Accounting Standard Board, they created a group, and that was called an IndAS Transition Facilitation Group, and they issued a couple of bulletins as well. I don't remember the exact number, but there were almost more than 20 bulletins where a couple of clarifications with regard to the roadmap or with regard to other areas was given. So this issue was addressed in the bulletin. So they made an input. Let me just directly come to this. In the present case, company C, it says company C is covered by phase 1 of the roadmap, and IndAS will be applicable for accounting period 1st April 16. I'll tell you now the reason why. We said it is phase 2, which looks at a parent level. But this clarification, when it came, see what they said. For companies which are not in existence on March 14, or an existing company which says falling under any of the thresholds for the first time after March 14, the net worth shall be calculated on the basis of the first audited financial statements after that date in which it meets the threshold limit. Hence, any company that meets the threshold limits in the rules in a particular financial year, IndAS will become applicable to the company in the immediately next financial year. IndAS will become applicable in the next financial year itself. So this company will get implemented in a phase 1. So let me put this again. That was a very interesting clarification. Based on what we did so far, anybody would believe that the implementation should go to the phase 2. But the ITFG brought out a very interesting clarification on the agenda. They said that if you say the company reaches a net worth in March 15, the companies which are applying IndAS for the first time, the companies which are going to apply IndAS for the first time, if you reach a net worth which is a threshold limit in the particular year, you're going to implement it next year. So in this particular case, the threshold limit reached on March 15. So this company is going to apply IndAS in the next year. Therefore, it became applicable on 1st April 16. Right. So this was a good, interesting clarification. Then I think let me ask another question as well. I think I'm going to answer one of the questions which was put forth by Ayush, I guess. This was regarding a foreign company. And yes, let me come to the illustration number 7. Let's go to the illustration number 7. This was also an interesting clarification in ITFG. So you can then see the other illustrations as well. I may not get time to cover every illustration, but the concept is done. So let me just have a look at illustration 7. ABC incorporated in a foreign country has got a net worth of 700 crores. I think let's document the diagram as well. So we give the company ABC, and this is supposed to be incorporated in a foreign land. And we are given the net worth of this company is supposed to be 700 crores. But it's not Indian company. It is supposed to be a foreign company as per the directions given. Then he says it has got 2 subsidiaries whose net worth on March 14 is 600 crores. And there is a company Y whose net worth is 150 crores. So this company has got 2 subsidiaries, a company X and a company Y. It says the company X has got a net worth which is supposed to be 600 crores, which is on March 14. And the company Y has got a net worth which is 150 crores. So very interesting facts given. So there is a company ABC, which is a foreign company. It has got 2 subsidiaries, X and Y. This company's got a net worth exceeding the threshold. This company's got a net worth exceeding the threshold. And this company has got a threshold which is not exceeding the threshold. But let me tell you, these are group companies. These are group companies because what you can technically call these 2 companies as company X and Y, since they are subsidiaries of these company, we can technically call them as fellow subsidiaries. So once you say that there is a parent company and there are 2 subsidiaries, we can say those 2 subsidiaries are supposed to be called fellow subsidiary. So the issue which came on the IndAS bulletin was that if the company X becomes covered under IndAS, will a fellow subsidiary also get covered under IndAS or not? So that was the agenda which came in. Let's see. So it says where the company X and Y would be required to follow the Indian accounting standard for the period starting 1st April 16 on the basis of their own net worth or on the basis of net worth of ABC. So the question was that would the IndAS get implemented for company X and Y based on their own net worth or looking at the net worth of the parent company, which is not even in India, but it is a foreign company. Let's see what the IndAS bulletin said. So they noted a company X has got a net worth of 600 crores. They will be required to prepare its financial statements based on IndAS on 1st April 16, undoubtedly clear. So as far as company X is concerned, if you look at its net worth, it is within the threshold limit of phase 1. It is undoubtedly covered under the phase 1. Then he says, while company Y having a net worth of 150 crores would be required to make financial statements based on the accounting standards. So X will be required to make it as per IndAS and Y will be required to make as per accounting standard. Now this would be creating some kind of trouble as well. So see what it further said. So what it further added out here is, since the foreign company is not a company incorporated under the Companies Act, it is not required to make financial statements based on IndAS. The parent company ABC is not an Indian company, so it will not be required to make financial statements based on the IndAS. It says as the foreign company is not required to make financial statements, net worth of the foreign company would not be the basis for deciding whether the Indian subsidiary X and the Indian subsidiary Y is required to make financial statements. So in this particular case, the role of the parent in terms of deciding does not come into play. Let me clarify. if this company ABC was supposed to be a company in India, if it was an Indian company, then company X by default has to apply IndAS. Company Y by default has to apply IndAS. Because we said related parties will also apply IndAS. So in this particular illustration of this was an Indian company, its net worth is more than the threshold limit. Company X, irrespective of the net worth, gets covered. Company Y, irrespective of the net worth, gets covered. But since only the parent company is not an Indian company, the role of the net worth of this company does not come into play. You're going to consider the net worth of company X separately and the company Y separately, and then decide the implementation takes place. Since in this particular case, it's a foreign company, therefore company Y is not getting covered under IndAS. The net worth of the parent has got no role to play. Right, so this is one. Now, if company X is a subsidiary, I'm getting some questions. If the company Y is a subsidiary of company X, would then it apply? Yes. Even if you say that company Y becomes a subsidiary of company X, yes, it gets covered. The main thing is the role of the parent company in terms of deciding the IndAS implementation for the subsidiary is going to be covered only if the parent itself is covered under IndAS. Okay, I'm getting another question. So as a conclusion, if the related party is incorporated outside India, IndAS does not apply. Yes. If your parent company is not supposed to be incorporated in India, then you cannot tell that my parent is going to apply IndAS. Then I'm going to look at your standalone financial statements to decide the status. But the moment your parent company is incorporated in India, I'm going to look at your parent company's net worth, and I'm also going to decide your fate as well. Correct. Okay, so that was few illustrations on the phase 1, phase 2 implementation. And now we'll just quickly work on the NBFC's part before we close our introduction to IndAS. This was pretty easy. As far as NBFCs are concerned, we decided that they will implement IndAS on 1st April 18, provided they've got a net worth of 500 crores or more. The holding company, the subsidiary, associate or JV are already covered under this, will also get covered. So the basic input was the limit of 500 crores or more. NBFCs with a net worth of 500 crores or more and the related parties are covered under the phased manner, that is 1st April 18. So let me just quickly go back where I just left the box empty. Let me just add on the notes out here. So in this case, we can say that if the net worth is supposed to be 500 crores or more, and we also covered, you can say, the related parties as well. So all those companies which have got NBFCs, net worth 500 crores or more, and related party. Finally, we are standing in 24. My storyline is now almost over. And finally, I need to go back to my storyline, and let me just come back to my storyline for the last time. So we are standing at 2024 onwards. So what is the status as of today? What is the status as of today? Is every listed company covered under IndAS? Yes. Is every potential listed company covered under IndAS? Yes. No ifs and buts. Is every unlisted company covered under IndAS, provided the net worth is 250 crores or more? Is every company free to apply IndAS? Yes. Are the related parties, the parent, subsidiary, SO, JV, also required to follow the IndAS if you are a related party? Yes. And moving forward from 24 onwards, as I said, in terms of 25, you could see the banking sector, you could see the insurance sector that would also implement IndAS, hopefully soon. That takes care of my entire story today. There are a few illustrations which are there in the study mat for your reference as well to read further. But I think we have covered up the entire concept of introduction to Indian accounting standard. Welcome to financial reporting subject, I would say. Okay, so now let's take some few questions. I think, no, the question stands answered, I guess. Yes, I think the question stands answered. Okay, so over to you, friends, if you've got any questions coming in. So let me tell you that today was basics, giving you fundamental clarities in terms of IndAS. In the next session, we are going to discuss in terms of standard IndAS 1, which is very much connected in terms of Schedule 3. The next two sessions is going to be devoted to IndAS 1, which is going to be very crucial. So I would request everybody to very, definitely take out time and attend these sessions, because your next two sessions is going to create a structure of the entire building on financial reporting. I'm going to give you a lot of inputs, which will be a grounding work in terms of understanding the Indian accounting standards for the paper, but also gives you a lot of good insight practically as well. So can you suggest any reading from the study material for us relating to today's lecture, which topics we can read? You can go back and read chapter number 1 of the study mat. The chapter number 1 of the study mat deals with the introduction to IndAS. These illustrations which I did today are picked up from the study material chapter 1 itself. So you can definitely spend time, read that chapter, do some remaining illustrations. I've done a couple of illustrations. There are more illustrations in the chapter. So you can read this, make your own input notes as well. This will be shared to you, of course, on the ICAI LMS, and you can make your own further notes as well on that. Thank you so much. You explained in a very interesting way. Thank you so much indeed. That was great. Very impressive start. Thank you very much indeed. Okay. So may you explain in a mixed language like Hindi and English? That could be a little constraint for my friends who may not be aware too much of Hindi, but we'll see in between, maybe we could do that flavor. So if subsidy X applies IndAS, then the parent company will apply. Then what will happen? Other subsidies of some parent company, they will have to voluntarily apply, because as a part of the group company, if one of your subsidies is getting covered, the parent is getting covered under IndAS, the subsidy is getting covered under IndAS. So even the fellow subsidy on a voluntary basis will do. It would not be mandated, but then consolidating would be a problem. So it would be more appropriate for practical reasons that the other subsidiary is voluntary, goes for IndAS. Thank you, sir, for the wonderful technical enabled class with wonderful explanation. That was a pleasure, and it was wonderful indeed to interact with all of you. So looking forward to the journey on Thursday with you. So have a wonderful day ahead. Thank you very much. Bye-bye and take care. Will you take all the classes of FR? No, these will be mixed faculty taking classes. I will not be taking the entire FR. Right, friends. So thank you on that. We take leave from you. Thank you. Bye-bye. Take care. हाँ जी, class over.